Here we go. Good evening, everyone. Thank you for joining us today. My name is Denisha McDonald with Financial Education Associates, and tonight we have the lovely Miss a.wortzman with us from Eastern Bank. And we're going to be talking about some tips to help you qualify for a mortgage and just understand what different down payment assistance programs are out there. As we start the top of the year, I think, I want to make sure people are aware of what's available so that you can start planning and be strategic so that when you are ready to press go, you're not going to be declined, right? Because you're going to have all of your documents, everything in place so that it's an easy, stress-free, hopefully seamless process with you and your loan officer, okay? So, Financial Education Associates, we are a HUD housing counseling agency. So what we do is help you guys prepare for buying a home. We provide your first-time home buyer classes. So when you need that certificate to go to the lender to get your down payment assistance, that's what we help you with. We also offer counseling sessions so that we can sit with you, figure out your finances, put a plan together so you know what you need to do before you go talk to a lender. We also offer landlord classes. So if you are thinking of purchasing a multifamily, we have classes to support you there as well, which is also a requirement for the one mortgage and mass housing if you're utilizing either of those loan products, which we will talk about tonight as well. Um, and then for those of you who don't want to sit on a Zoom like tonight, for the 8-hour class, we have our framework class, which is a self-paced. If you woke up and said at 2 a.m. you wanted to take a class, you could do that, right? You can watch it. It's self-paced, and then you schedule your counseling session, and you'd get your same first-time home buyer certificate at the end of that. So today we have a lot to talk about. I encourage you guys to put in the chat any of your questions. No question is too silly. If you don't want the world to see it, send it privately to me and I will ask it out loud for Amy. We want to make sure that you guys are prepared, that you understand what the process is and how to navigate it, and just some of the nuances, because there's a lot of changes that have happened. There are products that have been launched since Thanksgiving. So again, there are opportunities there, but there are some things that you need to pay attention to. So we're really excited about tonight. So I'm going to stop sharing my screen. I'm going to let Amy say a few words and then we'll get started.
Perfect. Thank you so much. And thank you everyone for coming on. I know during the week, like we said, it can be busy, and dedicating your time and energy to this space already shows us that you are interested in making this happen and doing the work. And there is some work, and we're going to hopefully go over that roadmap and framework to exactly that, make it smoother, make it a better experience, but also something that I've always said should be crafted to really be an empowering experience versus something that makes you feel small, and something that feels really glorious and like a huge achievement rather than like exhausted by the time you get to the closing. And we're going to talk about that a little bit more. Um, to back up for just a minute, as I think about the education that we're going to go through and the information, I want to give you also some context and just bring us together as we think through things tonight and close out the noise from the day and what's ahead later. So for right now, we're going to focus in. And for me, I have focused in really deeply in this space, this first time home buyer, using all the tools, learning the tools and sharing the information. Because when you have the information, you are clear and can make a decision versus feeling really uncertain and anxious. And then again, that goes back to that experience. So I want to share just a bit of my background. I've been actually doing mortgages for over 20 years now. And I grew up in New York City. I'm bilingual with Spanish, and I've constantly worked with a diverse loan set, meaning all different products, all different clients, different languages. And for me, it's brought me a lens that hopefully I can share with you, whatever your perspective is and how that's going to fit into banking and lending. And it's that alignment sort of between you, right, and everything about you, and then what the bank world needs, and then putting them together to getting a good mortgage, getting a good house, and then really sort of forgetting it all, right? Just making the payment and moving on with your life. So let's dig into the meat. Let's get into this stuff, right? Because there's a lot of information out there about mortgage products. And before we get into that, I want to bring it up one level higher, is sort of this, what I'm going to say, macro system of money. Like, where's the money coming from? And like, why does that matter to you? It matters because the rules that I have to follow are different depending on where the money comes from. So let me use some words that I start to familiarize you with as you get into housing a bit more and as you learn. So we have loans that are called conventional. Conventional can also sort of be traditional. That's what people say. That's your Fannie Mae, Freddie Mac. Those are housing agencies. And each of those housing agencies has a set of rules, right? So I could do something a little different, maybe under Freddie, maybe under Fannie, it's different. And I'm just starting to navigate you through this, getting you familiar with the words. Now, we said conventional is one lane. Another lane is what they say is government bond loans. And those are some initials like FHA, Federal Housing Administration, VA, veterans. And if you're a veteran or a service member, thank you. Genuinely, I always pause, and there's some things that we can actually add into files like credits and different things like that. So please put your hand up and let us know, when the time comes. So we also, like we said, we had FHA, VA, and out in our rural areas, we have something called USDA, which, believe it or not, can be as specific as a street address, like your neighbor house across the street doesn't qualify. All these different cool lanes, right? So conventional, government bond, and then we have something called portfolio. And portfolio is when a bank or lender, an institution, can write their own rules and they hold those mortgages on their books. Where conventional and FHA, you can hold them, but you can sell them on the secondary market. Again, we're just getting familiar with how this money is working. We're going to dwindle it all the way down to like the specifics so quick. You're going to be like, what just happened? All right. So we talked about, right, our lanes. And after portfolio, we start to get into things that I'm not going to like pass judgment on them, but they're not as traditional. So you might think the old days of what they used to call subprime, it's just different guidelines. These are called non-qualified mortgages today. And those might be some different loans that don't follow Fannie or Freddie, but they can still meet a client's need. And what am I talking about? Let me just give you a quick example. Fannie, Freddie, I need your income taxes, I need your pay stubs, I need your W-2s to figure out income. Maybe over in the non-QM lane, maybe you're someone who I can see a better income through your bank statements and deposits based on like you're self-employed. That's a bank statement loan. That's a different way to calculate, higher risk, different lane, and we can all start to figure out that's higher terms, right? So the earlier stuff that I mentioned, the earlier product set and loans, is actually really where we want to focus because those candidly are the most traditional, most conservative, and the most costly in a good way, right? Like not costly to you. So I want us to now tune in to the mortgage products themselves that I get super passionate about. I'm going to share with you playfully. My nickname at times is Lone Ninja because we use all the tools, right? We have a lot of fun with that. Exactly. Like it's the layering of these tools. It's the knowing how to product pick and work with a client to literally make the loan as cheap as possible. I joke with my colleagues when I got so deep in this space, I started focusing more on the initial equity my clients were getting than the size of the loan. Meaning, how many grants could we maybe get them? How many deferred loans? How many resources can we pull in to push your loan amount down? That's cool stuff. That's where the magic is. So I'm going to talk about how we do that. So again, you can start to hear about this. And then we're going to talk about how do you do it, right? Once you qualify, there's this operational piece of the process that I really want to walk you through because that is where you can do the most prep work after you leave the call today. Okay, first part, more education, telling you about products, programs, and then we're getting into how to do it. And that's when we're going to do pen to paper. So, in Massachusetts, we are so fortunate because we are a leader in what you would say is affordable home lending products or, solutions to this affordability crisis. And the affordability crisis, you might hear it, you might feel it. High prices, incomes aren't really moving, and interest rates are high. So people qualify for less. Well, home prices didn't come down just because that happened. So now we have a really strained market. And guess what? We don't have enough homes to begin with. So you're adding another stressor to this already super competitive pressure cooker market. So what we need to do is crack the puzzle to figure out, again, how do we make that affordable to you? And how do we do it in a sustainable way with candidly a 30-year fixed mortgage? A 30-year fixed mortgage never changes for 30 years, right? That stability really is amazing when you think about what rents do. right? Rents go up and up. I haven't seen many landlords lower rents recently. And I've really picked up a lot of clients because candidly the rents go up and they're like, I'm going to go buy a house instead. And when you do the numbers, this is a piece that I call loan magic. And Denisha and I have gotten really into this number thing because the math speaks for itself sometimes. Like literally, I can look at what you're paying for rent. We can do a backwards model and figure out what would that be in terms of like home ownership. And I'm going to pause here. The reason I'm saying home ownership, when I take a rent payment, please remember going into mortgage land, we're going a mortgage, we're going into taxes, we may have a condo fee, there may be homeowners insurance. We're going to talk about that whole housing payment. So, like for now, we could say that home ownership cost. You could get broader with that. But in my world, I'm just going to give you a funny nickname. It's PITI. They call it pity. And I'm always laughing because it's so like dainty, right? But it's your big mortgage payment. So we need to understand, again, how do we figure out which product is best for you? In Massachusetts, and please listen up, this is one of those moments where you want to like tune in because I'm going to teach you something right now about the system and the loan products. If you imagine a dartboard for a minute, and I want you to really think about this image because I've thought about this thing for years. And here's what it is. The best mortgage products for first-time homebuyers represent the bullseye. It's the hardest, smallest circle. And what I mean by that is there's a list of lenders and people can literally do these loans. And this type of loan is called a mass housing partnership, and it's called MHP. And the website for that is www.mhp.net. Okay, these are some of the programs and products we're going to start with out of the gate. But remember, it's that bullseye. Well, the mortgage world, the mortgage market of people that do loans like myself, we're sort of more like that whole dartboard. And I want you to hear me on this because I'm going to be very real with you. I've been doing loans for 20 years. I've been in and out of the banking system. I've been also in mortgage company space. I loved mortgage company space for a long time and it was good to me and I had a wonderful like moment. But here's the thing. I could not write an MHP loan. I could not write that product. I didn't have it. They don't do it with mortgage companies. It only goes to credit unions or banks with depository accounts. Now, when I was working with my clients, I went over the products that I had. And that's not a bad thing because this is the way the system is. But if I had a client that was maybe possibly qualified for MHP, that wasn't my lens. I didn't have the product. I didn't know. And so I found out about it, got really existentially again. Remember, I told you deep in the space, needed to find a place I wanted to work that had this product. And alas, here we are at Eastern Bank. This product can't really be touched. And what I mean by that, again, it is a 30-year fixed note. It is discounted. And when you come into this product, you can come in with like a 640 credit score. You only need 3% on a single family or condo, 5% on a multi for down payment. And guess what? Listen to this part. There's no PMI, no private mortgage insurance. So when you're running the math on this product, it's numerically better than other products because of other, let's say, PMI or interest rate things that go into it. Now, not everybody qualifies for this loan. There are specific income limits based on the size of your household and based on the county that you are buying. Please hear me. It is based on the county in which you are buying, not where you live today, right? And I need to know, oh, beautiful. Thank you for that. This is a resource I check like every day. If I have a file and I'm working my numbers, you go in here, you see how many people are in the household. And remember, I'm saying household. It's everyone in the house. We have to look at that income, even if they're not on the loan. Okay, so let me give an example. I have a household right now of 6 that I'm working with. 4 people work, but 2 are going on the loan. Okay, that's a lot of calculation. And I want to highlight this for a second in terms of income. I want you to just hear me on this. Income is one of the hardest parts of this whole process. And we're going to talk deeply about that after we finish up products. But I want you to just know for a minute, Amy said mental note, income is the hardest part. And we're going to get into know why. Okay. So MHP will allow the client to have up to these income limits, and you cannot have more than right now 75,000, or did it go up to 100? 100, right? We're sorry, we're at 100 already. 100,000 liquid. When I say liquid, that does not include your retirement accounts. So no 401ks, no IRA accounts, but it doesn't include checking savings, if you have some stocks. So we'll talk about that. But I want to be very real with you. The majority of my clients near 100,000, not an issue. Like I take files in and talk to people with like way less zeros than that. And like I love that. I get to be the banker that runs around going, I want to talk to the underdogs that have no money and figure it out and find the money. And that's a beautiful piece of work, right? That's passion. But it's true, it's like a puzzle. Um, so when we work on these puzzles, MHP is one set of programs. They have come out with something that is meant to, again, help the affordability crisis. But here's the other thing we've all noticed in this world: it's hard to save money. So people need some more help with the down payment and the closing costs. So MHP and some other entities, there's private money, there's public money, has launched as of Thanksgiving a product and program called MHP One Plus. Time out.
Pause. Time out,
Yes.
time out. Yep. I'm
Oh,
interrupting. So, guys, you'll hear me interject once in a while. In the
please do.
chat, for those of you who aren't paying attention, I try to put summaries of what Amy is talking about and links. So you'll get the links to all the things as long as I
Oh,
can
look at you.
find them
Yeah,
while
thank
she's
you.
saying it for you. So I'm her support in the background here. But
Love it.
I wanted you to explain, can you talk about like what is this whole income limit? Where do they get these numbers from? And why is it different depending on the county? So I'm looking at Plymouth
Yeah.
and a one-person household is at 72,900, but in Suffolk County they're at 91,400. So why is it
I
different?
Yeah, they pulled this from, and I don't remember candidly if it's like the HUD income or if it's like the federal FHFA. But to be a more broader answer, it's coming from government sets. Like the government sets these income limits depending on different things in housing. And then sometimes, depending if an agency or other entity wants, they can like work with different. So I'll give you an example. We're going to talk in a minute about a program called Mass Housing. No P, no partnership. They have their own income limits. So when I, like to Denisha's point, she's pulled this up for one product. If all of a sudden I'm working in another land, I'm pulling up different income limits. It's not all the same. And that is to your point, confusing to say the least. But also let's focus here on MHP because this can happen. Let's pretend we have a client who initially says, I want to buy in Boston. And so we're in Suffolk County, which you see here. Let's go just play it out. Household of three, 146,900. Okay, that client goes out and they're searching all around, and they happen to go visit their cousin, and they're over in Worcester. Okay, they're visiting a cousin in Worcester. So let's pop down to Worcester County right below. Next page down, if you will. Okay, and we're a family of three. Oh my gosh, we're down to 105, just over 105. Well, what if my borrower was making what I needed in Suffolk to like hold that product, and all of a sudden they go out to Worcester? That might bust. And so this is an example of why like being aware of these sort of things is important. So if I have a client that says to me candidly, I'm going to look in Boston, I'm going to go out to Worcester, I think I'm going to South Shore. To your point, we're going to give them a little like, hey, time out. Because if we're in MHP land, we need to know, are you going to go somewhere maybe that income drops? Another thing, household income can change depending on who's in your household. Okay, so the family of six that I'm working with, they've recently had some family come over from Haiti. And as I said, two aren't working. They're going through the process. But since we started the pre-approval, two more members of the household have started working. So these things can move on you. Another little trick of the trade, kind of fun. If we as a lender are trying to figure out how do we calculate your income, right? How do I know what your income is for this product? I'm going to share with you now exactly how I do it and how it's done. We take your pay stub and we look at your full year to date. And what I mean by that, that's with everything you've earned, not just your hourly. If you had any other type of income, the juiciest, biggest number on your pay stub. I'm going to figure out what week it is in the year. I'm going to divide, and then I'm going to multiply by 52. And sometimes that number is egregious, is way more than you've ever made. Okay. But it's all based on that year to date. So let's pretend for a minute, real life example. You're in first quarter of this year. You're about to get paid a bonus from the end of last year. It's about to hit your pay stub. When that bonus hits your pay stub and I get that pay stub, sometimes, believe it or not, yes, that year to date is too juicy for this program and we kind of have to wait. These are things that we talk about. These are those little devils in the details, right? How I told you income can get really snarly. And this is what I mean. It is what it is until it isn't. And I don't mean to scare you, but like knowing that is important. To the flip side, not busting, but here's an example. Let's say it's like end of 2024. And I had a client who was earning all this stuff in second and third quarter. I'm making this up. I know that in first, second quarter, that person may be able to hold compliance income. That's part of the strategy. That's part of the really cool stuff. And that, my friends, is what like I as a lender would talk to you as a client about, but we also talk to a realtor because let's play it out. What if all of a sudden you're not finding a house, you're not finding a house, and now we're in that third quarter where everything is juicy again on your pay stub, and now you're not an MHP? Well, if we've done our good homework, we've already prepared for that. And we've created a second plan, which could be a nice segue into our next product set in a minute. But I can't, I got to tell you, just I have to tell you about MHP1. It's been so
Mhm.
great. Okay.
Yeah.
So MHP1 Plus is, listen to this, everyone, feel free. It's going in the chat. I know it. It's 2% down payment assistance. So if I need if MHP says in their guidelines, they say you as a borrower must contribute a minimum of 1.5% of your own money. Okay, I didn't tell you that part. I said 3% all day long, but 1.5 of that has to come from you. Okay, now if MHP 1 Plus is giving you 2%, so we have 3.5%, and we're good. Like we're really good. We have an extra 0.5%. Okay, now you're not only getting down payment assistance, you're getting a 1% rate reduction. So let me give you some real numbers as of today. The Mass Housing Partnership MHP rate today, before any discounts or enhancements, was 6.625. If you were doing a 1 plus, you would get a 5.625. That mathematically is very helpful, right? If I get a lower interest rate, I can either make something qualify a little bit better. Maybe I can have a scenario be cheaper for you, or candidly, maybe I can push the purchase price up for you. Okay. So these are important things as I look at where you're buying. Now, the thing about MHP1 Plus, this is kind of cool, but also a little thing you have to remember. It is based on where you live today, not where you're buying. So you have to be in beautiful. There's our list, the 29 communities we have listed up here. And you have to look there, meaning I do, to see do you qualify. If you are living in any of these 29 eligible communities, we can consider this program. Doesn't matter where you go by. So we said we had 2% down payment assistance, 1% rate reduction, and then believe it or not, we have money left over for closing costs. Now, just so you can hear it, so that you can again be very educated in the space, the spend, if you will, of the 2% helping your down payment. Now, you don't see it, but on the back end, something goes on between the lenders and MHP, and there's money used to give you that 1% rate reduction. You don't need to see how the sausage is. It is delicious. You get that 1% discount, take it and run.
I love
Like,
that
just
analogy.
go, right? Like, just take it and go. So, the closing cost down payment and what we do to get that rate reduction cannot exceed $50,000. That's a nice bucket to work with. So really, let's simplify that. Like, what did Amy just say? That was a lot of numbers. She did a lot of things. I'm going to tell you straight up, here's what it means. I have put files together on this product where you come in with 1.5% of your own money, and the rest of the money is from the program. Quickly, we are getting to some numbers that people are like, wait, I have that in savings, or, ooh, I have a tax refund coming, or this could
Mhm.
work. Okay.
Mhm.
Your income and what you're earning to help me qualify is one thing. Do you have the cash to close is another. This product has been a huge, huge help because I've been seeing a ton of people, they have the income, but they don't have the cash to close. Okay. That's a truth. I just want to see. I think we had some questions really quickly. Let's go in there.
Yep, I mean, it's when you're talking about income and qualifying.
Yeah.
I'll wait for you to finish this and I'll bring them up.
Yeah, perfect. I took a mental note and I want to come back to that because that's really great for our next section when we get into like how do you qualify. Um, I want to leave you also with two other enhancements that MHP has. They've really kind of gone very aggressive in a good way. In Lowell, Massachusetts, they have a version of this where they give you 3% towards a down payment, 1% rate reduction, and again, money for closing costs. That bucket, believe it or not, is a $30,000 bucket. Okay. So if you're buying in Lowell, the property itself is in Lowell, I might use that product. And then the longer standing sort of veteran program, if you, I shouldn't say veteran, I mean like older program, is Boston One Plus. And you may have heard of this one. It's been around for a while. This product in Boston gives a client 5% towards down payment. You get money for closing costs. And then here's the cool thing. I want you to listen up again. This is big. This is huge. Remember Denisha had the grids where it said like one income and then another? Well, one bucket is what they call 100% AMI, area median income, a government number. Like they say, okay, here's that number. That's what it is. 80% area median income, AMI, is another bucket. Now, in Boston, we can do a 1% rate reduction for our friends in the 100% AMI bucket. But for our friends in the 80%, we can do a 2% rate reduction. So let's talk about that. We said our going rate without anything was 6.625. 1% is 5.625. 2% means 4.625. That's awesome. That's a 30-year fixed, no private mortgage insurance with 1.5% out of, well, in Boston, I still need that 1.5%. But again, you can see this product is really solid. Like it is so traditional in terms of like what it does and the tension, like the real drive behind it is exactly sustainable, affordable home ownership. Like keep the payments low. And the banks work with MHP as a housing partner. This is definitely something that is crafted, right? Like this money and these discounts aren't for free. So it's a partnership. And that's why you see an approved list. And the mechanics of how it works on the back end, it's a little bit complicated, but not in the way that, and I say that with you to you because I want you to know like I have a really large opinion on a lot of things in housing, and I advocated like when I was in a mortgage company, I was trying to figure out could we figure this out. And the answer was like, no, because guess what? When you have an MHP loan, remember I used that word portfolio earlier on? That's what they are. The banks hold these loans on their books. So what's also really nice is if I have a question on an MHP loan as a consumer, I'm literally calling the bank I did the loan with. Now, I'm going to get a little, here you go. Candidly, you should feel super comfortable at any point to call your loan officer if you have a question. We're going to talk about that later. But just hear me on that, right? Like it's nice to know that your loan is serviced by the bank that I did it with. You may not know or even have an idea of like, why is she saying that? That makes no sense. Like, of course that makes sense. But no, banks and mortgage companies can sell these loans and they go out to big companies that get servicing. They buy that part of the process. So there's all these weird big ones that do it. And I don't want to like it's not a scary vortex or like the Matrix, but it's not as like easy necessarily to navigate that, right? It's a bigger system, and that's okay. Um, so we talked about MHP and all their enhancements, and we also now are going to talk about mass housing because these are the two that I really want to stay focused on tonight. And mass housing has within its umbrella at least 3 or 4 different programs based on your income. Now, here's where it gets cool. Remember that lone ninja? It's like, ooh, where are we going with it? Well, if I'm in the mass housing space, I don't necessarily have to look at the household income. That's only one of their products. And I'm going to give you the colors they code them with. We've got yellow, we've got blue, we've got green. Yellow has the lowest income limits. Okay. They are now going to go to 60% area median income. Okay, that is pretty low in certain markets. Some markets the numbers work, others not so much. Now, my green and blue products have some really liberal, juicy income limits. Like there's one that's just under 192,000. Some of these programs, you can't like have owned a home within 3 years. Mass housing says basically you can't own it for more, like you could close and sell a house in the morning and buy a house in the afternoon with them. Okay. It may change a few things, but they allow it. MHP, absolutely not. No ownership for the last 3 years. Now, mass housing is a little bit more difficult at times to qualify for if, and I'm going to editorialize, right? Amy's going to interject Amy's opinion here. And Amy's going to share this with you because I've done a lot of these loans. In fact, I was like talking to someone about this. You're going to laugh with me on this, I hope. But we've heard of artificial intelligence. When you, as a loan officer, put the information in the computer on a mass housing loan, okay, you have to actually like run it through software to see if it says yes or no. And I joke with people, I say, well, those are little trolls in the back end and they're looking at everything. And what they're looking at is really layers of risk. And the algorithms that decide if the loan is a go or a no is literally like all, no one knows, right? But they're set by Fannie Mae and Freddie Mac based on the rules. So here's what I've noticed. If a borrower has like a 680 or below credit score and is trying to come in with a low down payment like that 3% we talked about, and maybe they don't have that much in the bank, and maybe like, it's a tight deal, meaning the income qualifies, but it's kind of tight. We'll talk about that later. Those layers of risk could, even though it sounds like a good deal, make that one say no. Now, as a distinction, I just want to go back to the mass housing partnership for a second. I do not need to use any of those algorithms or run it through a software. It is the good old fashioned, does it meet the numbers? Yes or no. It's so refreshing. It is so refreshing. And another reason why I, as someone who loves to write loans, got back into a space where I had the ability to write what they call a manual underwrite. Like I said, does it fit the boxes? Yes or no? So nice. Right? We're not tinkering with these like algorithms and they call them findings. So I'm going to say the words again so you can hear it. Fannie Mae uses something called desktop underwriter. Freddie Mac uses something called loan prospectus. Guess what? Same scenario could have different outcomes based on how they underwrite. Okay, I have learned, given the markets I play in, that times Freddie Mac can be easier than some of the Fannie Mae stuff. Okay, we'll talk about that later. But one of the reasons I'll share with you now, Fannie Mae says I have to take 1% of your student loans if I don't see a payment. So many people have deferred loans. They don't show me a payment on the credit report. Fannie says I need 1% of your loan balance to put in as a pretend payment. Freddie says, go with a 0.5%. That matters so much on numbers. But here's another thing, my friends. I worked somewhere else before Eastern Bank, before I got to out of the mortgage space. I'll share with you because it's kind of funny. I think I left the mortgage company space. I jumped over to First Republic for like 4 months before the bank started to fail. And within 6 months, ended at Eastern Bank. But here's one thing I realized and didn't know I didn't know. When I was at First Republic, they were a Fannie Mae only shop. I didn't even have Freddie Mac. I was losing my mind. I was like, what do you mean, right? Because there were pickups that I wanted under Freddie. It was just an interesting thing. So the thing I also learned in that moment is if a lender gives you a no or says something doesn't work because of whatever reason, it might be a great idea to put your hand up, come back to Denisha, come back to me, whoever, and say like, hey, I wonder if there's a second opinion. The answer is yes, because let me play that out for you. Let's pretend the client that came to me that was trying to buy a condo, who I said didn't qualify, because with all his student loans, he didn't qualify, but I did the math for him anyway, and I figured out at 0.5% he qualified. So I was really honest, and I was like, hey, listen, you can do this. You just have to go over to like one of these places that I know has Freddie and run with it, because um, Mass Housing Partnership will follow Fannie, but Mass Housing will do either Fannie or Freddie. Okay, so these are those nuances you don't know. So imagine if the client or me hadn't said anything, he's like, oh man, I don't qualify. He would have missed an opportunity to buy, is my point. So when you hear no, please don't take it as that person is 100% right. And I say that with love to my professionals in the industry. I say that to you as consumers, but like, always get a second opinion. Because I'm going to tell you, I've closed a few loans in my life where people have said no, and I just am like, ha ha, right? Because that's awesome. right? Turning that around into a closed loan for someone is just amazing. You bring that whole spirit right back up. All right, we talked about MHP, we talked about mass housing. Now, I want to tell you quickly about what funds mass housing offers for assistance. So, we have two different buckets of income with mass housing. If you fall within the workforce advantage, that yellow product, it comes with a $30,000 deferred loan at 0%. A deferred loan means it does need to be paid back unless it is what they call forgiven. And a loan that is often forgiven usually has a scale going down over about 5 years, right? Every year, a little less is owed until some point it, goes off into the sunset. Now, some loans are forgiven, some are not. These are details that you want to look at. Same thing on a loan. Well, excuse me. And I think, and I'm trying to remember clearly. So I think with the mass housing 30,000, because I talked to them, it's about theirs runs in the same as your first mortgage. So theirs, I don't believe is forgiven. And so I
Yeah.
said, play it out for me, right? If someone pays off their first mortgage 30 years from now, what happens? And I'll be very honest and real with you because that's the way I roll. They were like a little deer in headlights, like, oh, we haven't been asked that. And I was like, well, I had a client who wanted to know. Because again, you need to know these details because if all of a sudden a loan is due and you're surprised by that, you didn't have that information clarity. So if I know that my client is maybe going to sell that house in 7 years, right? I have to warn them and say, hey, you're going to owe some money back on that. Don't be shocked. And that's about planning beyond just that first purchase before, beyond that closing. It's important to know if you're using resources. Is it a grant? Is it a deferred loan? Is it forgiven? And guess what? I just made your head spin on purpose. None of you are going to remember all that. And that's part of like learning, but also building the right team that that like can look at all that for you, can explain it. But all you need to know now is this. Okay, if I'm using a first time home buyer resource, do I have to pay it back or not? Keep it simple. Okay. That's the nugget I want you to take. And that's the one that you can bring to any like loan officer. And you can be that blunt. One of the other things I talked about today with someone is like how you interact with your bankers and your teammates. Like, enter that with confidence. And when you have a question, bring it up. You shouldn't feel hindered asking questions. And if someone does make you feel sort of like, oh, why is he, she, they asking it? And like they make you feel weird, that is a red flag. That is not a teammate. That is not someone, in my opinion, that is part of your power pod. We'll talk about that later, but I could go on and on. So I also
I'm gonna
mentioned these
pause for
government,
one
yeah,
second, wait.
please.
So that was a lot of information, guys, a
Yeah,
lot of
let's talk.
amazing information. So thank you so much, Amy. I have a list of questions, but I know when we're talking about income is when they're going to come in. So guys, I did not ignore you. I have a little
Perfect.
Word document. I've copied all of your questions, so we will get to them.
I love
But
it.
do you guys have any questions specific to what Amy has gone over thus far? So not your individual specific questions, but anything that you were confused about in what she's discussed so far. Because we've learned about the one mortgage, we've learned
Yep.
about the one plus and the one plus Boston, the one plus Lowell, and mass housing. So you guys have gone over quite a few products in literally half an hour, just so you know,
Isn't
and
that
you are
wild?
more informed than a lot of people out there. And if you're paying attention, I think it's really important when you start the process that you interview who is going to be on your team, right? A lot of times we're going to get, I always say, ask a friend or family member who has purchased, right? Who did they use? But you want to get a couple names, right? You don't want to go with the first person because, like Amy said, if they only offer certain products and those aren't the ones that you need or are best for you, you're going to miss out, right? Because you didn't ask. So you want to make sure you're talking to different lenders who offer different products so they can run the numbers to find what works best for you. Okay? So we talked about, you heard mass housing, you've heard the one mortgage, you've heard the one plus, because some lenders offer the one, but not the one
Yep.
plus. So this is why it matters, right?
Yep.
Um, you guys in your home buyer classes, you've heard of FHA, you've heard of conventional, all VA, like you've heard of everything, but not all lenders have all of these products. So you might have to talk to one who has everything, someone who has one, not the other. Why? Because their interest rates are different also, right? The fees that they charge you might be different as well. So you want to interview so that you are a very informed buyer when you make your final decision, because you only get one pre-approval. That's what's tied to the house. So you got to do your research ahead of time to pick the one.
I love that, the one. That's true. Yeah. Yeah. And I love that. Like, we'll just quickly kind of, we're not going to gloss over like government bond, the FHA, the VA. But what I can say to those is they do have more liberal guidelines, right? They have different ways that they set up their private mortgage insurance. The thing that I pause, I guess is a good way to say, on FHA. It's become a product that I look at last because the PMI to me is what is a double dip. So they're
Mhm.
collecting money up front as like an upfront premium. I think it's up to like 1.75% of that loan amount. It can go into the loan amount. You can finance it. I don't need it from your pocket. But remember the goal I said about building equity from day one? Well, if I'm adding more to your loan amount, now we're getting into bigger payments. The other thing is they charge you monthly for it, and they charge you monthly for the life of the loan. So the only way you could get out of that PMI is if you refinance an FHA loan. So that's further cost, right? Depends what the rate environment is. And there's a time and a place for an FHA loan. I've seen scenarios you might be saying, all right, Amy, what is one? Well, sometimes on a 3 or 4 decker, it can be easier, but it can also be a nightmare. But I see a little more success in the multi property. Like that's for where I've seen more because again, we've been able to work with a lot of these mass housing and mass housing partnership products. What drives me crazy and is an industry issue, and if you talk to, let's say, like people who are involved in just fair housing, which is a whole other side of lending, they don't even touch loans. They look at tons of spreadsheets, candidly. So if you look at fair housing lawyers and people that look at that data, one of the biggest issues in housing is disproportionately FHA is used when borrowers would have qualified for a different product. And the reason is this: with that dartboard that I told you about, that list of who can do who, the tiny one, bullseye, is the smallest list. Then you start going out. You've got people at mortgage companies, you've got mortgage brokers, you've got good and bad apples everywhere. I'm not saying one is better than the other, right? Because I've worn those hats. But what I am saying is that the list for mass housing partnership is one list. The list for mass housing is another list, a bigger list, because they do allow mortgage companies, but not everyone does it. And so here's the reality. And I'm going to speak from the heart. Again, this is Amy speaking. This isn't like Easter. Again, what I have seen, when you now layer in what I say is a language need or privilege, right? Like, again, I've spoken Spanish since the day I was born. This drives me bananas. Disproportionately Spanish speaking mortgage brokers offer FHA when a client would go into another product because they don't have it and a client feels comfortable. And so when Denisha is talking about, like, yes, talk to your uncle, your cousin, or whoever, absolutely. No hands down question about it. But they may not have the product, so you have to know to ask. And then you can do a real comparison. Because let's play it out. Let's pretend you are the borrower who straight up needs an FHA loan. We've got apples to apples to compare then. But if you're someone that I can put into an MHP loan and that person doesn't have any product like I do, I'm going to tell you right now it's going to be apples and oranges, right? I don't even like the math is the math. Okay. So I'm highlighting for a minute something I've seen because I've been so into this space for years and years is the trend of, if you prefer to speak another language, please again just do ask the question on the product, because when you look at the list of who does these products and who speaks another language, it gets even smaller. And I'll tell you right now, there are people on these lists, I've seen their names, they don't even write the product. It's just there. So
Mhm.
it just, there's a lot of stuff to comb through. And so if you get out into the wild, wild west of whoever can do a mortgage, you just got to go there. Like I'll tell you, as Eastern Bank, I cannot do a non-QM loan. Remember I talked about those other loans? I have a friend, adore her. She's been my colleague and like one of my friends for like since college. She works at Cross Country Mortgage. She's a fabulous lender. My friend has so many different products that she could put a loan into. It's just not a product set that I have. It's different. You see what I'm saying? So you have to be smart about that. We've covered so much in products. I think it's a good time because now we're going to get into the fun part and we're going to get into this income stuff, which is going to take a lot, right? This is going to take a
Mhm.
lot because this is where you kind of make it or break it. Okay. We can play with assets, meaning you can save more money. You can over time, right? Hopefully get a savings account up. But if your income isn't moving, it is what it is. And so we've got to work with that. And so the question of what do lenders need to qualify is a really good one, because I'm going to give you the overarching sort of what do I need to qualify, and then we're going to get into the nitty gritty. And it's in the nitty gritty where you're going to start to see what it means to be certain on your numbers, knowing your numbers. I drill this down to a point where I believe I've been called tenacious by some underwriters. I mean, I have taken things like all the way because I want to be absolutely concrete about my numbers and your numbers. And here's why. When we as a bank, as a lender, review your file to say, are you eligible? We are looking at your credit, your income, your assets, and we're looking at the property itself. Now, when we teach the first time homebuyer class, we get into what's called the 4 C's, right? And they list this all out. It's like credit, capacity, capital, collateral. Okay, I give everybody some extra C's, which I'll save for you at the end of this. But in the income section, it can be really onerous, really tricky to properly convey what you're doing and how you're making your money. And let's play this out for just a quick second. And I want you to understand the process. You and I are talking. I'm listening to you tell me everything you've done for the last 2 years. Everybody, that's the snapshot I'm focusing on in your life. So from today, back 2 years. I want to know where you've worked. I want to know if you've done any schooling. I want everything. I want your start and end dates. Okay, I don't want to guess. I want you to know. And if you don't know, respectfully, I need you to go find out because we're going to verify, right? Everything is going to get verified. So on your section of income, we're going to give you at the end a checklist that I use as a resource and a tool. But I'm looking at what have you done for the last 2 years? Okay, have you moved jobs? Has there been a promotion? Has there been a change to your income? Like all this stuff I need to know. Did you graduate and then start a job? Okay. I love that. There is no fibbing. Oh, no, 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 no. We will, oh, we find everything. It's fun. It's super fun. But you know what? If you do your homework at the beginning of the process, there's no surprises. And that's what we say about loan landmines. Nothing should explode in this process. I go on a crazy tangent about if people have high denial rates as loan officers, something's wrong because you have all the information. Remember that word certain? You can achieve it with really good documentation and communication. Ooh, there's the first C, an extra C I dropped right in there. That's an extra one. All right, so let's talk about this. You've come to me, I listen, you fill out what's called a 1003, an application, an inquiry, whatever you want to say. It is a document where I get all of your residency, so enough to pull, meaning, for example, not just are you a citizen, non-permanent, or visa, what's your status, but where have you lived for the last 2 years? Are you in one spot? Did you move? I need all of it because it's going to show on your credit report. Your social security, your date of birth. That's what we use to pull credit. Then you give me all your employers, addresses, phone numbers, start dates. And here's the fun part. There's a section for you to fill out the income. I love it. Now, if you're someone who is paid, let's say hourly, salary, and it's really straightforward, that is an easy number for you to pop in. Now, I want you to hear me on this. The income that we use to qualify your loan is your gross income, meaning before taxes. Juicy number, not how you live. You live off of your net. Let's do a quick comparison. We talked earlier about do I fit into the mass housing partnership income limits? And that number, my friends, was the juiciest of all. Remember, I said, I'm going to take everything in your year to date. Well, now I've gone to almost the other side of the coin. Now I'm talking about your qualifying income. What is an underwriter going to agree with? What does the data support? And this is where it gets really intense, not in a bad way, but let's get through it. So you have an hourly at 40 hours. Okay. Maybe you've done some overtime, maybe got a bonus, and maybe you even make some commissions. Each one of those is also in your pay stub. Your base salary is what it is. Not a problem. I can calculate that all day long. But those other income streams are called variables. Those have to be averaged over 2 years. So, guess what I say? And this is, you're going to see this on the checklist. You're going to hear me talk about this later too, but like over and over. Having your end of the year pay stub from 2024, 2023, and possibly even 2022 would be so helpful at pre-approval, because I don't need to get in touch with your employer, and I don't need to guess based on your W-2s and try to if and when maybe. I'm going to look at your old pay stub and I'm going to pull the number out. I'm going to say in 2023, Marco made $10,000 in commission, 2,500 in bonus. And then I do the same thing on the prior year. And I add those numbers together and I divide by 24. The reason I'm walking you through that math and sort of saying it with a little bit more of a tone is because if we just like talked about this and you said, oh yeah, I made my bonus and my commission and everything, it's been pretty standard, la la la, I'm not working with the real numbers. I might know that it's about this, but I don't have the real numbers. I want those pay stubs. I want the end of the year pay stubs to do the math so that nobody can question my number. Because when somebody doesn't do the income right, it's very ugly. Okay, here's why it's pretty ugly. Today's market is pushing first-time home buyers to the edges of their qualifications. And what we mean by that in banking world, your debt to income ratio, so how much money you're making compared to the debt load you're trying to carry, is always pretty much near the max of what these programs will allow. So imagine if a loan officer, I'm just saying, it could happen, does happen, they submit a file, the income is wrong, they lose income, the debt to income busts open the deal, and now the person can't buy the house. To me, that's egregiously horrible for so many reasons. You've been dragged through the mud, you've wasted your time, you've wasted your energy, you've wasted money. But here's the thing, had you just given those pay stubs, had you been asked, the math would have done at pre-approval and that risk would have not even been on the table. And so doing that due diligence and having that kind of documentation is really important. So some of you might be thinking, no problem, I can pull those and get them, no problem. Right, I'll go on my computer. Some of you are thinking, I have no idea how to get that. Like I don't even, I think my money just goes into my bank accounts, direct deposit. I don't know if I have pay stubs. I hear it all. And so what I'm saying here, the exercise of getting your documentation together could be hard. It could be like a second job for a little bit, like creating your financial folder, whether you go old school and paper or you create a digital one on your computer. Please, if you can, go digital. But if you end up needing paper, it's okay, right? We're going to help you digitize that. Um, but the point is, when I work a file from day one, I am going to look at all that information and ask you for it. So also, let's go through the list on the income section. 30 days of pay stubs. Okay, depending on how you get paid, it could be 4 pay stubs, could be 2, could be 1. We don't know. We'll figure that out. 30 days worth of pay stubs. 2 months of bank accounts. So anything that we're using on the transaction, we need 2 full months, and we might even need some other accounts that we're not using, but we're showing as extra money. Those are called reserves. Okay, that plus 2 to 3 years of taxes. Let's get into it. We've got, oh, you're going to pull it up. Fantastic. All right, thank you. So friends, over here is a checklist that I've used. And oh, this is a little bit old. We got to update our years, but not a problem. So what you're seeing here, right? 30 days of full pay stubs, and full is that information I talked about with the full year to date. Okay. Those averages save me so much time. They save our processor. We've got 3 years of taxes. That's how we verify you're a first-time home buyer. But if you're self-employed, I'm doing some averages there. I will not work a file for self-employed borrowers unless you have your tax returns. With all due respect, don't waste my time. I can't tell you what you qualify for without them. And listen to me right now, my friends, if you are self-employed, here's a Freddie Mac secret that I love and I love about this time of year. Freddie Mac says, if you have been self-employed for 5 years, and I can prove it, not hard to do, 5 years or more, I can qualify your loan using your most recent tax return, your single most recent tax return. So if you're going to go file your tax returns and you're self-employed and you're trying to buy a house this year, maybe you go over the deductions with your accountant and see what makes sense and what doesn't, right? So
Yes.
focus in on that. Um,
Do not write everything off if you are planning to purchase a home, because you
right.
need to show income. And if you have written everything off and you've deducted everything, your income is going to be low, which
Very
means,
low.
although you know you can afford the house on paper, which is what the bank goes by, you cannot.
Exactly. And so what I joke, I don't really joke. I sort of say, like, when we talk, like you and I, clients, anybody, we're speaking like human. We're talking to each other as humans. When I take the story of you, which is your loan application, I am converting that into documentation. That is the language of the bank. And so oftentimes, like I have a teacher right now. This is kind of interesting. My processor said to me today, he's like, "Wow, that income's complicated," but he said, "I love what you did with your memo." And here's what we did. Again, the client came to me. She's a music teacher. She teaches at probably 6 to 9 different entities, depending on the year. But out of those 6 to 9, three are the same, and three of them are the main sources of income. She earns some money through her self-employed tax returns and the other through W-2. Over the last 3 years, she's earned roughly the same amount of money, but in a different combination. So I was feeling the heebie-jeebies on this one. Not because I knew I had income stability. I knew it. I wasn't worried about that. But I was worried about a perceived loan landmine. And here's the nuance. And these are some of the things that just candidly comes with experience. I was concerned because she's been a musician since 2011. I've got plenty of, I can prove that. I've got the 1 year return. But I went to my underwriter and I was like, how do I best present this? Because as doing the calculations quick loan officer, I knew in a heartbeat that roughly I had like 50 to 52,000. So back at the napkin, we're talking, I'm doing the pre-approval. Like I know that in my heart, that's the number. I'm close to that. But when you break apart the W-2s and the dates, you really do isolate to just three of them. And so I want you to think for a minute, what if I did the calculation using more of those sources, but she's not working at all of them right now. And so I actually can't prove that she still has that job. And so in this case, we kind of clawed back the income a little bit. And we went with the three sources that we knew she was still at, that we could get pay stubs, and that she had a solid 3 year history. Now, here's the interesting part, the other income that may be coming in is still going to count in her compliance income. It's not a whole lot, but it exists. And the rest of it is a little bit more conservative. But it's way better to play income conservative and get more than go the other way. Now, friends on this file, I kid you not. I love that they are first time home buyers, I think in their late 60s. This is so cool. They, one is a veteran, so that was awesome. We were able to get a $2,500 closing cost credit from Mass Housing. They have so much debt because they've helped their kids. Okay, I want to just share a number with you. Okay, these people are making over $100,000, and at first glance, you might be like, "Wow, that's a lot." But they have almost $3,500 in other debt between the cars and the student loan. So it's almost like they own another house on paper. When we start to do the math and we do that, what we call debt to income ratio, I'm going to take your gross income and I'm actually bringing that number down to like 43% or sometimes 36%. And that's the most that you can hold. So when Denise was sort of like, yeah, I can pay that. We were talking about this earlier. Just because you think you can pay it doesn't mean on paper you can't. So for this client, what I was thrilled to hear, because they're just like, they're so cool and groovy. They really are. I love it. She was like, we just want you to know, we know what we can afford. And guess what? They're buying a condo at 257,500. It's a tiny little condo that suits their lifestyle up in Lynn. It's like, they love it. They're so excited and the numbers worked really nicely. So I didn't want to push them and they didn't want to push themselves, which brings me to something that I ask all of my first time home buyers, all of my students. And we're going to do a tiny little bit of like a pause gut check for you. And it's this: those clients, as I said, had an understanding of their means, what worked for them, and it happened to align with my numbers. Okay, that was nice. Here's the question I want you all to think about for a minute. What would you want your monthly mortgage, tax, and insurance payment to be? Now, some of you have a number. Some of them you were freaking out that I even asked the question, and some of your brains are still spinning. And that's, my friends, exactly what I want to have happen. And here's why. I can do all these glorious calculations all day long. Let's play it out. Let's pretend that I did the math. And guess what? You qualify for $5,000 a month. Fantastic. Okay. Half of you just had a heart attack that I said you were going to pay $5,000 a month. The other half is still processing. How could that be? That's like way too much. Right? I do that to make you laugh, but also it shows you that sometimes the paper calculations are disconnected from the reality of your life. And so when I ask you that question, I want you to tune in with your budget. It's really to say, do you have any idea how much you can comfortably spend? Because here's the thing, I don't see your daycare if you pay it. That's another house in itself. I maybe don't see other debts that you don't have on the credit report. I don't know if you owe your uncle money and you're paying him. I don't know if you're sending a bunch of money home to relatives in another country. These are things you know. These are things that are in your budget. So when I ask that question, it also helps me because I can go backwards. It saves us a lot of time. So if you said to me, Amy, I'm really comfortable at $2,000, $2,500 a month, I love that because here's what I do. I take out your condo fee, I'm making this up, I take out your taxes, and I go backwards with the interest rate. People are always like, whoa, it's a mortgage calculator on my phone. It's so groovy, but it saves us a lot of time because we can frame things fast, right? So if we've identified what you're comfortable paying, then I can work the numbers. But here's the thing, I like to give you a little wiggle room. So maybe we do look at, just so you know, what is the maximum on paper? Okay. I just wanted to digress there for a minute because it's so important to tune in with that question at some point and just start to figure out what is your number? What is it? You're gonna know emotionally. It's so true. The body tells you, right? Like when I threw out 5,000, there's like a feeling of, oh my God, no. But if I said 1,200, everyone here probably feels so relaxed. And that's really like what I'm trying to say there. It doesn't have to be a whole data spreadsheet. It can really be just thinking and feeling, or it could be the spreadsheet, right? I've seen it all. So
I'm in
let's
favor of the spreadsheet,
see.
guys. I'm just going to interject and say, I want you to know your numbers. So I really do, and that's something that we do with
Yeah,
your housing counseling is make you do a budget worksheet so that
awesome.
a lot of times we don't pay attention to the cost of living, right?
Yeah,
We just know I have enough money every month to survive, right? Everything's getting done. But you really need to sit and do the numbers to figure out, well, what's important to you, right? So if you love to travel, right? But you also want to buy a house, we have to factor all those numbers in because maybe without the travel, your budget might be $3,000 a month, but you said you want to travel a lot and we don't want you going into debt. So we need to set money aside for that. Your budget should be $2,500 a month for a house, right? Or like Amy said, you have daycare or you have sports activities or different things that you still have to pay for, right? Utilities, they're not counting utilities, but you should, right? You need to look at what that is so that you know how much you can afford because the lender is going to give you the big pre-approval. This is based on paper, the things that are on your credit report. This is how much you can afford. That's not your reality because you live on your net. After taxes, FICA comes, everybody takes out all their money.
yep,
You have to live on the rest of that. So you really need to understand what that is. And don't let, I'm saying this and it's easier said than done, and I understand that. Um, know your numbers because when you get that pre-approval and you get out there, it's really easy if they just gave you the max to look at houses that are at the top of your budget. That's not realistic, right? So the payment might come back at 3,100, but it's really supposed to be at 25 because you're so in the emotion of buying a house. You're like, I just want the house. offer higher. It's like, but you can't afford higher. Like that's gonna leave you living paycheck to paycheck literally once you purchase that home. So I want you to know your numbers, have that conversation with your loan officer, have that conversation with your agent so everyone's aware to make sure that you stay on track, right? And you might have to adjust what your preferences are, but that's worth it so that you don't lose the house in a couple of years because you can't afford it, right? We have to make sure that we're being smart in the beginning so that we don't stress out later on after we own the house. Because when that toilet breaks at 2 a.m.
Oh,
and
you
that
gotta
water
go
heater
home.
goes, you need to have that money, right? There's no landlord coming. So you have to budget for all of those things when you're thinking about home ownership. And I think in the past couple of years, a lot of people, they're just so eager to
The frenzy.
purchase,
Yeah.
they weren't paying attention to these things, and you're getting the calls of I'm missing payments, like I am having a hard time making my mortgage payment this month because we didn't plan up front about what that is. Okay.
And that is not where we want anyone to be. Like
Nope.
that is definitely like ugh, no. And Denise is touching on truly like as I threw out there that frenzy feeling. And as you were saying that, one of the things I was thinking about was there are certain buyers I work with and they're really good and rigid and they hold the line. But it's true, like the emotion and the desire and like sometimes the frustration of the search for a home can push you. And so, what can happen is maybe you're a $350,000 buyer. You've unfortunately put in 10 offers, none have been accepted. You are out in the market, there's a house for 375, the rates are up, they're higher. You need to now negotiate. Next thing you know, you're at 400. You've pushed yourself. Now, that is a like you said, it's going to be an adjustment, it's a shock. It's maybe, and this is like this is the tricky part, just because I, as a lender, can get it done doesn't mean it's the right thing for you in life. But my job is also to focus on can I get that loan done for you? And I'm going to just speak from the heart actually for a second because it brought up something that I want to share. A personal friend of mine, a personal friend of mine has money, made a decision to buy a place, sell a place, the whole nine. She chose me to be her lender. There's a lot behind the story, but I got a call from her one day and she was like kind of venting and she said to me, "You shouldn't have let me buy it." And I got to tell you, that felt like a smack in the face, but not in the sense of like I was upset because I had done wrong. I held the line immediately and I said, "No, no, like I refer, like she wasn't push on paper, like it wasn't anything like that. But the thing is, you gotta own that, right? And that's what I'm kind of saying. And I kind of made her clear of that in the moment, and sort of like, is it no, you were fine. Like, I'm sorry you hate your place and all these other things, but like as a professional, the reason I say that is again, I don't want anybody looking back and being like, ugh. I hate my agent because they pushed me into it. Oh, my lender shouldn't have. Like, no, we talked about a celebration at the end. So I just wanted to share it because it happens more than you know. And we really want to keep you away from that. I want your budget to feel good. I want you to be able to buy the blinds you need when you get in. These are real things. For me, I'll tell you, when I got into home ownership, it was like, oh my God, I have to pay for garbage. And all of a sudden I'm paying for water. And because I lived in a condo and I was like, oh, okay. And oil? Ugh, oh my God, shut that off. But these are things you learn. And to Denisha's point, I have to own it too. I'm putting myself through a budgeting exercise this year because I am the queen of talking about it. I'm the queen of starting them and I never finish them because I'm always like, I don't like to know. I own that. I'm owning that this year. Right? I'm doing the pen to paper. So first I chose to go notebook style and I'll see if I put it in Excel. But I just want you to know, friends, like I do think it's that important that I'm looking in the mirror. And so hopefully you won't have to look in the mirror because you'll just have done it and it'll be great. So let's go back for a second, get a little bit more into income because I've said it's the juiciest part like of the file. But assets are important too. But let's talk a little bit about the different types of income, right? So I get the question all the time, are you looking for me to be working my job for 2 years? Ideally, yes. Do people change jobs? Absolutely. Do we have life occurrences? Yes. So let's play a couple out. You just graduated school, you're starting a job. I can explain that. That makes sense. The job you're starting, though, needs to be like easy to calculate, meaning you're not a consultant who's getting a 1099 because a 1099 is self employed. Self-employed, I do need you to have 2 years of working. Okay. There can be some cases where if you have at least 12 months with reported income, you may be, depending on the past history, be able to make a case for it. But more often than not, the answer is no. Okay. So 2 years minimum of self-employment, no wiggle room really. Happy to always to have a discussion, but that's a really good average for you. Now, if you have someone who's W-2'd and switches to a different W-2 job, that's fine. It's easy to calculate. If you start in a role where the hours are variable and things start to really fluctuate and we can't really figure out how much you make, that's where it starts to get a little tricky. It doesn't mean you can't do it, but it means you've got to really get into it. And I want to give you an example. I have a loan closing tomorrow. The woman was and is finishing a PhD program. She has had two jobs. Um, Now she was able to, I believe it was like the history was she was doing the PhD, had a job, then picked up her other job, and so she had at least a year of working two jobs plus going to school. Now that case, that one, I was allowed to use both her jobs for income. Here's an interesting case that I brought up to my underwriters, and I tried to like set a precedent based on this one a little bit, which was this. Client was in a job since 2019, was in school to become a pharmacist, so holding the job while in school, graduates the pharmacy school, has a gap in employment, but kept that other job this whole time. So gap, and then gets the bigger full-time 40-hour a week job and takes the job she had from school and moves it to a part-time. Okay. There's a lot of twists and turns. So in essence, worked a job while in school, right? Graduates school, has the gap, keeps the job, right? So you hear me. Twists and turns. I, in my heart, kind of knew it wasn't as solid. But instead of going forth with qualifying the client with both her jobs, I had the knowledge, I had the experience, I had the heebie jeebies to bring this to my underwriter and give her the whole chronology. It was two of them. We had a nice discussion, but here's the difference. Because, of course, as remember, I'm your advocate. I was like, what about this one? We did this, da da da. Like, right, the hands on the keyboard. The difference in this situation was number one, I had a gap. I had a gap from school to the job. So, like, what was going on? And then the other piece was I didn't really have a long enough history of working the two jobs, even though she's guaranteed 40 hours. And even though she'd been at that other job since 2019, it didn't fit the box as much as it needed to. Okay. The box are those guidelines, Fannie Mae, Freddie Mac, part-time income. That section is really important. You've got to get into dates, start and end dates. Okay. Let me give you an example. You're someone who has worked two jobs, but your second job, you've only worked for 1 year and 8 months. Technically, I can't qualify with you with it, right? I can tell you what it might look like if your part-time income was ready, but I'd need you to wait like 3 to 4 months before I bring it in. So in that instance, I might have a pre-approval number for you today, and I might have a pre-approval for you in 4 months. Okay, so hear me on that. That's how important that is, that chronology. Okay, as a young loan officer, I mean, I'm not ancient, but like as a rookie, I got caught in that. I got caught once, and it wasn't like I didn't know. I didn't know. But my client didn't have the full 2 years. They ordered a verification appointment. Start date came back. It was short 2 years. I lost the income, deal busted. You can't always ask a seller to wait, right? Because there's probably two or three buyers behind you waiting for that deal to bust and steal the house, right? That's the jungle out there. And so when you execute, when you pounce on a property, we need to know you can close. This is no joke. Because guess what? I actually call these listing agents and vouch for you in the sense of I say, like, oh, you've been pre approved. And like we sort of go over the fact that, yes, we're human. We're going to answer the phone. We're going to work with you. And your loan will close. They want to know, have we looked at your credit, your income, and your asset? They are asking those questions. I have had listing agents ask specifically, have you reviewed the most recent 30-day pay stub? Believe it, they get into it. We never share your personal information. That is not their business. But you can see how people really want to know. And there are differences between, I'm going to be blunt, but like, calling into a vortex, Rocket Mortgage, like ticket number, blah, blah, blah. I mean, it's not exact, but, I exaggerate, but you feel me on that. Getting into those details again helps us be certain and helps me say, yeah, I've got all their documents. I can close that quickly. If I did not prep you on documentation at pre-approval and all of a sudden, let's play it out. Like you've got your life going on, you've got all these other things, and I now say to you, I need you to go get XYZ, that checklist we talked about, and you don't know how to get it, that's really stressful. That is not making this a fun experience. Okay, you're trying to find documents, you're feeling frenzied, you're feeling rushed, people are throwing deadlines at you, and you're like, but I need to work 40 hours and I need to do my other things. Like, I've heard people say getting a mortgage feels like a second job. It's true because it's something else you have to do, but if we minimize what like the process feels like, part of my craft and those I think that are good at what we do, that's really the key these days. It's not just giving you a good mortgage product, it's making the experience almost like enjoyable. Because it feels intense. I might be asking you for new pay stubs. Right now, we're asking a lot of people for year to date profit and loss statements. Clients don't always know what that is. A year to date profit and loss, if you're self employed, you maybe didn't file your tax returns for 2024 yet. I still need to know what that looked like. So you need to give me that information. I don't know if you have QuickBooks. I don't know what you have. But if all of a sudden I tell you I want that in 48 hours and you're a deer in headlights and now you're going to slow down your loan process because you can't get me your document and you have to close in 30 days, you see where this starts to go? This is the frenzy. This is the backlog. So take a breath, right? Like I did that on purpose. We're coming back down to the way it should be, which is planning and preparing. So we're doing that now. We're doing that
Mhm.
right now. We're getting your package ready. So we said we're going to get our pay stubs. We're going to keep our W-2s together for the last 3 years, all jobs that you've worked at. If you get a 1099 or a K1 or any of the other things that get stapled in there, save them, right? Save them. Start building this package.
Yep.
It is like gold when I get an application and all of a sudden the PDFs start coming right over. Do you know what that's like? I love it. I'm such a bank nerd. Or the zip files and it's all organized and ready to go. I love it. But think about this for a minute. Operationally, it's easier to work with. So it doesn't take as long to get you an answer because you want to know what can I buy. So if you have that paperwork ready, oh, it's glorious. If you're working 3 jobs, maybe I do need all those pay stubs from all 3 jobs. We're not sure. We don't know yet. We're going to have to see. Okay. Assets, bank statements. We talked about that. Let's talk format. Can't hear me enough on this, friends. If anything, when it comes to bank statement and assets that you are showing, I cannot take a screenshot from your phone with the bank statement on your desk. Okay. Sorry, no. I need every single page. Please do not send me every JPEG. I will roll my eyes and say horrible things about you behind your back, but still smile and say, I'd love to service and help you. But oh my God, don't do that because I can't get it into my system. Okay. But you should see what we get. A guy the other day, we were like, we need your P&L, your year-to-date profit and loss. He happens to be one of our Spanish-speaking clients. This was all in Spanish. It's a disconnect of just understanding. I love him, but he sent me a piece of paper and he was like, because he works Uber and Lyft and everything, and he was like a scrap paper. Don't get me wrong, we help him, we provided him with the right format and guidance, but I can't do that for him, right? So doing this legwork now. Assets, PDFs, so great. Even if the page is blank, I need it. If an underwriter sees page 1 through 10 and you give me 1, 2, 3, 4, 5, 7, all the way up, and I get it, I need page 6. I need page 6. I'm going to ask you for it. That's so annoying to hear from me at the end of the day. I don't want to get Amy page 6. Just send me the PDF. Same thing with brokerage accounts or anything you can, every single page. Please go through your bank statements with an eye. Just like look through. Are there any large deposits that would stand out to you or me? What do I mean by that? Well, if you ask a banker, like what's the rule? It's 25% of your direct deposit. So if I see deposit that's over that amount, I have to ask you about it. But guess what? An underwriter can ask you about anything they want. And I brought this up today with someone. We were talking about like bank statements and the information that people don't realize they can cause. And we call this the freaking can of worms. You hear that? Yeah, we get annoyed in banking because you sent me a bank statement and now you had another large deposit, but you didn't tell me about the account that the large deposit came from. So I say, I'm sorry, but I need 2 months of that bank account. And you turn it into me and you're like, here it is, no problem. And I see that there's this person on the bank account that I don't know who they are. And you're like, oh, that's just my mom. We opened the account when I was young. Okay, guess what? Now I need a letter from your mom, literally called an access letter that says that you have access to the funds in that account. Do you see how each thing unraveled one other? But if I had everything at the get go, we'd be fine. Recently, like within the last 6 months, we had a client very well qualified, tons of money. 2 weeks before closing, they started moving money all around and they did everything they said they weren't going to do. And my processor was chasing them for all the bank statements. Okay. So that's what I'm just sort of saying to you is like these documents can open things up that we don't want to get into. Okay.
Okay,
So
I'm gonna say pause one
perfect.
moment.
Yeah, let's do it.
Um, Amazing, Amy. Thank you. Guys, so you are after this session, you are going to receive an email with the document that I shared a while ago with the checklist of documents that Amy needs,
And I just
or
want to
a
point out, I
lender
think we have
needs.
to update the years on it. So just
I
remember
know.
the
I'll
most
have time to do
recent.
it
Yeah.
before, so I'll
Oh,
I'll
okay.
change it and
Thank
send it
you.
out again. Yeah.
Perfect.
So that you guys know what you need for when you plan to speak to a lender, right? So knowing that tonight, create a folder in Google Drive or Dropbox or whatever, house files, new home files, and start uploading those documents because you know you're going to need it, right? It's 100% chance you're going to need the documents on that list.
Yep.
Start gathering them now so that whenever you are ready to press go, you are ready because it's very stressful when we'll talk about lottery homes next month. But when there's a lottery due and they need a
Hmm.
pre-approval from you, now you
Oh,
have to go find all those documents in a week or two. Some people find out like days before. That's stressful.
yeah.
Versus you know today. Start gathering those documents now so that you don't have to stress about it in the future. Okay. I'm gonna pause because we have a few
Yeah.
questions from
Perfect. Let's do it.
before that relate to income, and you're gonna
Great.
probably restate. You've said it before, but I want you to say it again, specific to kind of these situations as well.
Mhm. Okay.
First question was, do I need to have the same income for more than 1 year? Or do I need to have consistent income for more than 1 year?
No, no. I would say certainly I would want to know what is happening right now. What's the income situation? How long has it been going on? And understanding the history going back 2 years. So there could be a reason that there's a change or something in that time frame. So we would talk through it. So not necessarily it doesn't have to be, but it's helpful. It's nice. But as long as it's going up, we usually don't care. If it's going down, we start to look at things more. Yeah.
Okay, thank you. The next one, if you are on maternity leave and getting paid PFML,
Yep.
um, is that taken into consideration or how is that calculated? How is that income calculated?
Yes. So depending on if you know when you're going back to work or not, we would potentially qualify you on that reduced income. Um, One of the things that I have had clients that are coming off of maternity and kind of going back, depending on that timeline, we are sometimes able to go back to the full income if the timeline works out with the closing. So I'd say kind of looking at where you are in that sort of time frame and then going from there. But yes, we can absolutely look at that.
So I think that for that, it's just being strategic in terms of when you start your process or when you're going through the home buying process there. Because again, you want the most income to help you qualify, most likely, to purchase that home. So just being really strategic. And on the flip side of that, I've had people who were working a lot of overtime and didn't qualify for some of these programs. I'm like, you need to stop now.
Yeah,
Stop
it's
working
true.
overtime. Like, what do you mean? I'm like, you need to stop because they're going to
Yeah,
count all of this income
uh-huh,
and it's not going to help you.
right.
So take a
I had a
break.
client, to your point, she got all excited. She was buying a house. In the process, she's a nurse. She jacked up all her hours, busted her year-to-date income, and believe it or not, it was so sad. We lost the city of Boston assistance because she went over income.
You went over
There
it.
was
Yep.
nothing we could do. Yeah,
And how can not a question there, but I do have it for you to for
yeah,
everyone to know. If you are working overtime, how is that calculated? If let's say I only work like 3 or 4 months of overtime, it wasn't and it's sporadic. So it's not every month I work overtime. I might work in January
yeah.
and not again till March, and then not again till April and then July.
It's
How
all
do you calculate
averaged.
that?
It's all average. So I would actually look at the history of how much overtime did you make in the last 2 years, look at the 2 years back, and then I'm looking at your year to date. If you're sort of on track for what you earned over those last 2 years, it's going to count. But to your point, there's probably going to need to be some sort of explanation because we kind of need to understand if you're in that gap of overtime, like why is it not being earned right now and is it coming back? Those are the hairy questions that starts to make me nervous of like, I don't know if I really want to use the overtime in my qualification. If there's a pattern, and that brings to mind seasonal employment, like if I have somebody, let's say in construction or landscaping, that goes on seasonal layoff in the winter, they're getting unemployment. If they've earned that unemployment for the last 2 years, we can average that in. I also need to know when they're going back to work. So again, that timeline can be important. Because Fannie and Freddie do not always necessarily let you close. Like an example is a new job. When are you getting your first pay stub? There's some guidance there as to when you can close, but some lenders and banks actually change it for how they feel comfortable. So these nuances are super important. But the overarching theme, if you hear me like, oh, there's a gap or there's a pause or da da da, that translates to not consistent. So as we like bring it back to lending language, not consistent means I need more information, I need a letter of explanation, and I need to see if there's enough here to pull it back in. And if not, play it safe, kick it out.
Awesome. And that actually was the next question. Someone who works in construction, so they are pretty much laid off every winter.
Yep.
Then they come back to
Yep.
work. So it's inconsistent and it's consistent work, but inconsistent in terms of how they are paid, how they
Right.
navigate that. All right.
Yep.
Awesome. Let's see. Let me see if anyone else has questions in the chat.
Oh, let's
So in
see.
terms of the tax returns, because now we're in tax season, this is like that
Yeah.
little gray area.
Yeah. Yeah.
Are you going, at what point do you require the 2024 tax return?
April
Let's do that.
14th, April 15th. If your file is after that, I'm going to require a tax return unless you show me that you have an extension. If you show me an extension, I need to know if you owe the IRS money. If you owe the IRS money, I need you to pay them and prove to me that you have paid them. If you are currently paying the IRS in a payment plan, I need to see that. Let me also share with you now, if you end up owing the IRS money for 2024 and you can start a payment plan, that is allowed. I need to know and see at least the first payment in a payment plan for it to be okay to pay it. Um, we have to understand, of course, that you're in a payment plan and it's not going to become any issue on your qualification. So,
Does that
um,
count towards your debt to income ratio?
yes, it does. It is considered a debt. Absolutely.
Okay. Even though it might be paid off before
If
you
it's
even
paid off, you're good. If you're in a payment plan, I hit you for the payment.
got you. There we go, guys. Okay, so let's see here. Is what changes if you are on parental leave? Does
Um,
anything change?
yeah, I mean, I would just understand sort of what the situation is with the employer, if there's, money or not, and we go from there. Yeah.
Okay. Ooh, that's a good one. Someone asked, they've been retired.
Congrats.
So for 1 month after 15 years of work. So now you're retired. What does that mean? I still want to buy a house, but now I'm not
Yep.
working.
So cool.
Great one.
Love it. So, wonderful section of income. We're going to call this more a fixed income in some ways, right? So, for retirement, we see Social Security. Sometimes we see pensions. Sometimes we see what's called a required mandatory distribution. So, people have retirement accounts and they're of a certain age, they have to take the money. So, we would look at what are your income streams now? And we would qualify you based on that. That's a really good question. Um, to give you more information and just educate here, I think this is a really cool section because retired people sometimes don't really have other income besides living off their assets. And I want to share something with you because I actually closed a loan this week using this tool. Remember, we talked about that pillar of money or that bucket called portfolio, where the bank can say the rules are what they want and they handle the risk themselves. There's something really cool that we were able to do at Eastern. I'll give you the framework so you can, again, be very educated in housing. When somebody owns an investment property and they sell it, they do often have to pay taxes. However, if they do what's called a 1031 exchange, keeping it simple, the money rolls through basically an intermediary like a lawyer, and there's a certain time frame for that client where they must identify and close on a new investment property. The rules of those 1031 exchanges are very precise, and if you go outside of them, the person then has a tax implication. I was brought into a scenario. A borrower found me. We started talking. The deal was cool. He wanted to buy with his wife, but we found out that his wife couldn't be on the loan at all. And so, candidly, we lost a lot of income. This client had a nice, juicy asset account. And guess what I was allowed to do? Something called asset depletion, which means I take the money they have, I discount it by 30%, and then I figure out, divide it by 120 months, and here's an income stream on paper we can now use for that client. It's called asset depletion. I just wanted to educate you on it because it's not something you can do in Fannie Freddie land. It's not something I can do in FHA or VA or USDA, but it's a really cool tool. And so when we have retirees that maybe are fortunate and have a bit of money in an account, sometimes that's a nice way for us on our first time homebuyer portfolio to bring it in, right? Like there's just, I just wanted to share craftiness or strategy with you because I love the retired section. Sometimes I'm mixing and matching too. So your point, like I might add social security, I might then do some asset, but depending on what you have, we'll take a look and figure out those numbers. And congratulations on your retirement. I can only
Oh, that's
imagine.
awesome. Oh,
Let's keep
that's
going.
awesome.
Mhm.
Okay, so I think that I answered everyone's question from the chat. There's one in
Perfect.
here now that just asked, does the mortgage loan or down payment assistance cover your HOA fees?
Beautiful. No, absolutely. Well, no. So down payment and closing cost assistance will go towards helping you get into the property, but you need to pay your monthly the HOA or condo fee to the association. Um, and actually, thank you for bringing up that because it triggered something I want to share. And we're going to kind of wrap up with sort of like, what are my last, like, what would I say to you as going off into the wilderness of buying a home? Um,
Okay.
you triggered something here with the condos. Condos are very unique in financing because we have to get them as an entity approved, meaning the condos have to fit certain requirements for Fannie Mae, Freddie Mac. Okay, that is called warrantability. Plainly say, like to say it really simply, the loan, if the condo is warrantable, great, makes my life easy. If it's non-warrantable, I have a big problem. If a condo is non-warrantable and you're trying to do a mass housing loan, you're dead in the water. Don't want to scare you, but trying to scare you. Because here's the thing, there are things on condos we need to get up front. Oftentimes, it's a budget, it's the master insurance, it's the condo docs, it's the master deed. And what we're finding in today's environment over the last year is that condos have gotten really tricky because insurance premiums have skyrocketed. And in order for HOA associations to try not to pass that cost through to raising the HOAs, one of the things we've seen is some corners cut on master insurance. If things are not lined up exactly how a lender needs in a master insurance policy, I have seen deals coming down to the wire. Everything is perfect about you, the borrower, and the master insurance causes a problem. Now, I want to be very honest with you. If I'm at a mortgage company and a deal is non-warrantable, all of a sudden you have less places to pivot. Where can you save the deal? Can it be done? Absolutely. Is it going to be as pretty of a product? No. MHP is a portfolio loan. Okay. At the end of the day, MHP tries to follow Fannie, but because the banks hold them on their loans, on their books, there's sometimes a little bit of wiggle room. We are dealing with a situation right now on pending warrantability. Okay, I'm going to give you an example. New construction, 105 units. They have 31 under agreement or closed. Okay, roughly that's 30%. Fannie and Freddie say I need to be at 50%. My client wants to close. The building's, oh, we're hoping almost done. We're trying to find that out. But if I don't hit a 50% pre-sale, I cannot take that loan to Fannie Mae or Freddie Mac. So here's what's going on in the marketplace. There are some lenders out there that won't touch this thing. Okay. There are some lenders that will do it and they'll take a couple units. I am in a conversation right now with management about where do we feel comfortable as a bank on a pre-sale. They don't like the 30. They'd love the 50, but we're kind of talking about, can I maybe get to 40, 45? Can't sell that loan to Fannie or Freddie, but you see how we're having that conversation where the deal is not dead. Okay, that is my point. I'm also sharing this with you because that's how detailed we get. It gets so detailed. And you're like, what? Are you kidding me? Amy, are you serious? But everything was perfect. I know. I had an agent the other day. I'm joking, but I know she was like, oh, I'm so surprised. I go, it's a condo. You're surprised? Come on now. And here's what the thing was. I'm going to share this with you because I was like rolling my eyes as a loan officer. This is how detailed it gets. We got the master insurance in for the condo project. It said it covered improvements and renovation as long as the unit owner had reported those to the HOA. Okay. Then the appraiser comes in and says, the appraiser says, yeah, I am. That was my son, everyone. Check it in. Checking in for bedtime. So he just said hi to you all. So cute. So the appraiser says, we saw these renovations in the unit from 10 years ago. And then the underwriter said, do you know if that was reported to the HOA? I'm like, are you kidding me? So I had to ask the agents. The agents are like, we have no idea. And so don't fret, the deal's not dead. We just had to make sure she had extra insurance called an HO6 to close the loan. Okay, I'm telling you these details because I find them really annoying, to be very honest. There's nothing we can do. We have to work through them as we get the information. So condos are quirky. I took in a file today for a single family home and my processor goes, oh my God, you do those? Because I do so much in the city and I do so much with affordable housing that we see a lot of condos, okay? So condos can be their own beast compared to you, respectfully. We just have to look at that. So let me wrap up with, if I was like in the elevator with you, because I love to challenge people to pretend you're on the 8th floor and we're coming down to the lobby and I have that much time to talk with you. I tell people that if you can express yourself and your ideas in that amount of time, like that's the gold, okay? I covered so much information with you. I could go on for hours. There's so much to all of this. But here's genuinely, if nothing else, to make your life easier, it is get your documentation together. That list that is coming out will save you so much time because if you think about operational logistics, okay, I want you to imagine a conveyor belt. I am a loan officer. I prepare a file that goes to a processor. The processor does a whole bunch of things, an appraisal, they work with the lawyers, they get all these things done. They work with the underwriter who actually approves your loan. Okay, that underwriter requests more things. They're called conditions. The underwriter sends it back to the processor who works with you and me. We get everything together. Now the file goes to the underwriter again. They put the final bells and whistles all day long. Done, goes to closing, and off you go. What I call ping pong between a processor, an underwriter, and a loan officer to you can be minimized if you provide a full package, meaning everything on that list, and if your lender asks for more, give it to them. Do not fight them, please. You're not going to get, like, I get snarky here, but if someone fights me hard enough on a piece of documentation, this is what I do. I go, oh, you know what? No problem. You have $350,000 cash, right? You're good to go. You're right. I don't need that. And I play it out to be a little obnoxious. And it's not like I'm pushing back in a playful way because with all due respect, we need these things to get your loan closed in a timely manner and you can't push back. Maybe you need a different format, but if you were like, I'm not sending you my pay stub, I'd be like, okay, we're gonna end this deal right now. And that's not who you are. You're in this class to learn, but there are people out there that have fought me on things. And we'll get into that another time of like what we might need and da da da. The documentation is really important. Know your resume. If you need a minute to go write your start and end dates or check your own LinkedIn, do it. right? Get that 2-year history really nice and crisp. Okay. That's where the trouble is. If you are somebody that moves your money around a lot in your bank accounts, please stop. Just keep it static. Okay. Maybe even try to consolidate into one. And I'll leave you with this little tidbit. If you are somebody who happens to have cash in your house, okay,
Oh,
that
yes.
is a thing for us to talk about before you run and deposit your cash in the bank, because I cannot prove where your cash comes from. So let's just be real right here. Banking requires a 2 to 3 month window. Okay. I'm not saying go run out, deposit your money, but maybe use your cash in life, let your paycheck sit. Okay. Maybe you hold the cash and you use it for like holiday presents. I mean, there are things we can talk about, but I can't talk about what I can do if you've made a large deposit and it's all cash. I've had deals kick it out. I want to talk very quickly about, because we work with different cultures, this is coming up more and more with my gorgeous Caribbean friends.
Susus.
The susus, right? I love susus. I get all, oh, my hand is coming up or it's my turn. Awesome. Don't get a bunch of cash. We got to talk first. Okay. These are things because candidly, I remember we said the banking world's its own world. You're never going to change the culture of a susu to meet it. Like, I'm never going to get all these like accounts and everything I need from a susu to prove that the money is eligible. No, like, I get it. That's experience, my friends. That's knowing details. That's having the confidence to tell your loan officer that your susu hand is coming up. If you don't feel that connection and that ability to be honest, that, my friends, is a problem. This is a very intimate, intense process in the sense that we are pushing to get you a house. Okay.
Mhm.
When you find it and your offer is accepted, there is no oops or oops or You've done your due diligence. So, in closing, I joke, but you know what I'm saying? Get your you know what together, right? Do your homework, get the docs together, and also know your number. When I say to you in our conversation, how much do you want to pay monthly? I want to hear it. Okay. I want to hear that number. I want it crisp. I want it confident. And I don't want to go, well, I could. No, know it. Just like when you hit the streets and you go to buy a house, I've given you realistic numbers on your pre approval to share with an agent. They take the ball at that point, go in the market, and that's the fun. That's when we start talking strategy. Can you go over? Can you go nuts? When can we close? And the last question that I know Denisha wanted me to touch on is, okay, great. You get a house under agreement. How fast can you close? Here's the thing. The comfortable window, in my opinion, is 35 to 45 days. If you need to close in 30 days to win the property, everybody needs to know, and you better have all your you know what together like yesterday. Okay. Deals sometimes are longer, and that's okay too. Okay. So everything depends on what everyone agrees to. And you can kind of see the uniqueness in each case, just like the uniqueness of your own application. So we did a lot tonight. We covered a
We did.
tremendous amount of information. The
Thank you,
point
Amy.
of this is to get your toes wet, to hear the words, to start feeling aware, and to start doing your own homework. So one of the things, thanks, Letitia, Denisha, just put on my stuff. You can call me, you can text me. I will say that if you could shoot me an email first, because then I loop in the team, and that's how we can also make sure that you have the best experience. But you are absolutely welcome to shoot me a quick text. Tell me, hey, I was in this session. I'm going to ask you for your email. I'm going to make sure I have your name because some of you are, so and so's phone. I just don't know yet which one's coming in. So we're going to just ask for that information. And then we're going to put you into our beautiful experience. A lot of work up front so that you cruise towards closing.
Yep.
That's the goal. That's the goal. All right, everybody. Thank you so
Thank
much.
you. Thank you so much, Amy. Guys, there was a lot of information tonight. And I wanted to have it, and part of why we have these topical sessions is because we can deep dive into specific things as opposed to an 8-hour class. We're trying to cover so much, it's overwhelming. Tonight, you just learned about what you need to do for a lender. So if you want a lender to work hard for you, for you to have a great experience, you just heard what you need to do, right? So you're going to get that document with the list of what she needs when you need a pre-approval. Start gathering those things now, right? You have Amy's email address. Reach out to her. Some people were sending me very specific situations.
Yeah,
Ask her about those, right? That's why you start having those conversations and building those relationships. She
100%.
said you can text her. I'm gonna just let you know it's best for everybody in our world. Emails are better than text
Okay, cool.
messages.
I
So
love it.
although I put it, that was my fault.
That's
Email.
okay.
email,
Perfect. So we'll start with emails,
so that
everybody.
it's just
Awesome.
easier to loop people in. Again,
Yes,
when
the
we talk
file.
about seamless process,
Right.
this is one of those questions you ask your lenders also. What is the
Okay.
best form of communication for you? They should be asking you that as well, right? Because some
Right.
people prefer text, some people prefer email, some people prefer calls.
Right.
Let them know that, right?
Right.
And find out what are their work hours, right? Some people think your loan officer, your agent should be available 24/7. Well, they have a family too. I'm sensitive to that,
Right.
right? So understanding what's that give and take and what are emergencies versus although I want the answer right now, it actually doesn't change anything in my situation versus asking you tomorrow morning. Understand that. It's okay. Right? So we're changing how we think about the process to make it more enjoyable for everyone. So again, thank you guys for joining us tonight. Thank you so much, Amy. This was
Pleasure.
an amazing
Thank you.
session. Clearly, you know your stuff because I didn't even get to ask a whole bunch of questions. I thought it was going to be like an interview, and she just kept going. I'm like, well, I'm
I
just
love
giving
it.
it
I'm a
to her.
storyteller. I love this work. I
I'm
really do.
just gonna give her the floor so she can just drop all the knowledge on you guys. So I hope you found it really helpful. I will upload this and post it on YouTube. So you guys can follow us on YouTube to get the replay. Once it's uploaded, I'll send an email letting you know it's up there as well so that you can watch it again and gather the information. You'll also get the file with the list of documents that you need to get a pre-approval period whenever that is, because it's not going to change. And I think that is it. Next month, we're going to talk about the lottery process. So going through all the details of that if you are interested in a lottery home. The month after that, if you know any teachers or educators, we're going to talk about the home buying process specific to educators and what different programs and down payment assistance is available for them as well. So our goal is to make sure that you guys are prepared. It's not so overwhelming of a process for you because I understand that it is a lot when purchasing a home, and that you see it's not something you can decide today and then go buy a house tomorrow. There is some preparation involved. Something that Amy didn't talk about tonight, but I want you guys to pay attention to is credit. We kind of touched it a little bit, but you need to have at least a 640 credit score for most of these programs, down payment programs we discussed tonight. So ideally, I try to get everyone to at least a 680 because if you're buying a multifamily, it actually does jump to a 680. So let's just get there to start. Um, so we want to make sure when you're going through your buyer's profile that you're in a really good position when you speak to that lender to get the pre-approval that you need. Okay. So thank you guys for joining us tonight. I will send out the email with that document from Amy for you and have a wonderful evening.